The turnaround story in the banking sector over the last half a decade has been the decline in non-performing assets. After rising to a high of 11.5% of total loans given by the banks in 2017-18, gross non-performing assets or GNPAs or bad loans declined to 5.9% in 2021-22. Banks have even weathered COVID and have been registering record profits. Industry profits zoomed in the second quarter of the fiscal year, with the public sector banks reporting a 50% growth annually and private banks witnessing a 64% rise. However, India's non-performing asset or NPA story hides a vital facet. Has it been improving quality and recoveries that have triggered this performance, or is it the consequence of banks clearing the assets of their books? Data suggests that banks have written off 10 trillion rupees worth of loans off their books in the last 5 years and have only recovered just 13% or 1.32 trillion rupees. A bank write-off of a loan when there is a low chance of recovery. It moves the loan from its asset book and shows it as a loss. It also helps that write-offs work as a tax mitigation strategy. If one includes these write-offs as NPAs and keeps them on banks' books, the total gross non-performing assets rise to over 13% for the industry from the current 5.9%. A business standard analysis shows that even though the ratio of write-offs to GNPAs or gross NPAs has reduced from its peak in 2018-19, the proportion at 20% is still high. Surprisingly, the write-off ratio at private banks at 26.6% was higher than the ratio at public sector banks. Our banking editor Manojit Saha explains the reason behind these huge write-offs.
Write-offs are predominant recourse for lowering gross NPAs, particularly for public sector banks. When a bank writes off a loan, it has to set aside capital, known as provision. Huge amount of write-offs were possible in recent years because the government infused over 3 trillion capital in public sector banks between 2016-17 and 2021. Banks will say that writing off does not mean they stop chasing recovery. In reality, they recover only a fraction from the return of accounts.
Another significant factor for banks opting for write-offs is the failure to capitalize on asset recovery. Asset resolution plans have usually failed to generate value, with banks taking substantial haircuts. Banks recovered only a third of the amount involved under the Insolvency and Bankruptcy Code process in 2021-22. The recoveries have declined over the last few years. Debt recovery tribunals and ARCs have even lower recovery rates. So, are we expected to see more write-offs? We talked to an expert to understand the future course.
I don't think we will go to see a similar kind of a write-off in the next 5 years. Even in fact, it would be even much lower. I don't even expect 20% of that 10 lakh crore to come in. But now, as the banking stands today, there was no bad corporate lending the banks have done in last 3-4 years. The retail is doing quite strong. SME, MSME is in a perfect shape. So, combining all this aspect, it would be very fair to say that banking as such is on a very, very strong wicket.
The resolution system will have to work for write-offs to reduce. More importantly, banks would need to be mindful of lending. The recent credit growth could push the banking system into a cycle of bad loans again.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.